Welcome, everyone, to our 2021 Georgia Department of Revenue Tax Bar Liaison meeting. My name is Richard Litwin. I'm the moderator from the Atlanta Bar Association Tax Section. If the other moderators could introduce themselves, please.
Is May Scunter. I'm a representative of the Georgia Bar State Tax Section.
And this is Frank O'Connell. I'm the Deputy Commissioner for the Georgia Department of Revenue and General Counsel.
Thank you all. A few housekeeping matters. First, thanks to Lane Sosaby and Mary Jo Sullivan at the State Bar and to Karen English at the Atlanta Bar for their help in coordinating this event. A special thanks to Lane for facilitating this Zoom conference today. Now, today's event is free to attendees, and we are getting CLE credit for it. Thanks to Mace for his hard work in getting the presentation approved by the State Bar of Georgia. No further action is required for you to get CLE credit. Lane Sosaby is handling. And finally, please use the question and answer box at the bottom of your screen to submit a question. Thanks to Commissioner Crittenden for your support of this liaison meeting. And thanks to John Foster, Ann Whipple, Charles Elrod, Ron Stay, and Dominic Capitosto for preparing their presentations. So now we'll turn to Commissioner Crittenden to say a few words. Commissioner, you get to unmute.
Yes, thank you. Good afternoon, everybody. Thank you for inviting me to attend today. My name is Robin Crittenden, and I'm the Commissioner of the Department of Revenue. I'm also an attorney, so it's great to be here with you today. I was honored when Governor Kemp asked me to take over this role back in July. I was excited about this opportunity for several reasons, but one that struck me the most has been the essential role the Department of Revenue plays for our state. In other roles I've held in state government, we had a specific mission to provide services for citizens of the state, and we were allocated resources to accomplish that mission. At the Department of Revenue, we are entrusted to collect the resources, which make all functions of state government and the essential services provided possible. What we do at the department upholds all other state agencies. Our work helps to ensure that Georgia is and remains a great place to live, work, start a small business, and raise a family. Now, this year, we will be focusing on customer service, process improvement, mainly through technology, transparency, and legal compliance. As attorneys, I'm sure that you are wondering what I mean by legal compliance. It is important that we interpret laws correctly and implement them timely and accurately. We will be paying special attention to this during and after the legislative session. As for our 2022 legislative priorities, since the governor included the Internal Revenue Code updates in the call for the special session, we're ahead of the game this year. And I know John's going to talk to you about that a little bit in a minute. But we're currently reviewing recent federal legislation to determine if any additional updates are required. It is my goal that the important work of administering the tax laws of the state of Georgia fairly and efficiently in order, to continue, in order to efficiently promote public confidence and compliance while providing excellent customer service remain at the forefront of all that we do. Because of that, because we administer the tax laws, much of our work is legal in nature. We always appreciate your input and feedback on your experience with the department and for your taking part in our regulatory process. We strive to maintain open lines of communication with those in our network. Thank you again for the opportunity to join you today. And now I'm going to turn things over to the rest of the panel to discuss their topics with you. Thank you.
And thank you, Commissioner, for being here today. Thank you for your comments. Thank you for your service. And of course, thank you for support of these meetings. That we consider them as lawyers, of course, very important for the bar and, for the, as you said, for the efficient processes in government. So with that, we will move on to John Foster to give his update on income tax issues. John, you could
Hi,
share your
everyone.
screen.
Yeah, I'll do that. And Richard, of course, speak up if I don't do it correctly.
Okay.
I'm what you would call an expert, not really. So it should be up. Can everyone
That's
see that?
perfect. Everybody I can see it.
Okay, great. Okay, so I'm going to be talking today. Let's see. There we go. Again, my name's John Foster. I'm the Director of Income Tax Policy. And I'm going to be talking today about 2021 income tax legislation. There's a fair amount. And I'm going to touch each one just a little bit. And I'm going to start with House Bill 32. That creates a new teacher tax credit. House Bill 114 makes changes to the adoption of a qualified foster child tax credit. House Bill 149 provides for an election to pay tax at the passive entity level, which I think of, well, that bill is one of the most important bills and probably the one that you would be most interested in, maybe other than the next bill, which is House Bill 265, which is the annual IRC update bill. There are actually two annual IRC update bills this year. There's also House Bill 70X from the 2021 special session, which the commissioner mentioned. We were really happy that that was addressed. There were some changes that affect 2021, so it's good to know that those have sort of already been addressed. I checked just before the meeting and it has not yet been signed, but it has been sent to the governor. So we would expect sometime soon. Moving on, House Bill 593, that provides for increased standard deductions. So that's for individuals. Senate Bill 66 makes changes to the qualified education donation tax credit. And then the final bill is Senate Bill 6. And I'm going to talk just about the income tax bills and kind of the provisions that affect most people. So sections 2-1 and 2-2, that creates a new life sciences manufacturing job tax credit. Section 4-1 provides for an extension of the railroad tax credit. Section 6-1 changes the historic rehabilitation tax credit. And section 7-1 changes the research tax credit. So moving on to the first bill, House Bill 32, as I said, this creates a new teacher tax credit. The bill, well, the way it works is that the Department of Education designates the teachers that are eligible. So they'll figure that out and then they'll let us know. And then we'll program our systems so that the credit is available for anyone who the Department of Education designated. The purpose of the program is to encourage both new and experienced teachers to seek employment with qualifying public schools in high-need subject areas. Moving on to some of the details, the credit amount is $3,000 for no more than 5 school years. And it's limited to 1,000 teachers per year. So what will happen is they'll designate 1,000 teachers. And then if they decide, the Department of Education, that teacher could remain kind of on the list, so to speak, for 5 years. So the credit amount can't exceed the taxpayer's income tax liability, which is true for most credits except for the timber tax credit. But there is a carryover of 3 years. Now, this bill is applicable to taxable years beginning on or after January 1st of 2022. So this is for the tax year that's coming up. And I think everyone knows it, but just to be absolutely clear, that would be the 22 year, and that would be returns that are then filed in 2023. So the department hasn't done a lot of work on this bill yet. But we are starting conversations with the Department of Education. And what we envision for this bill is a new credit code will be added to the form INDCR. I think most people know it, but I'll explain a little bit further. We have what's called Series 100 credits, which are the business, usually business type credits, but sometimes it does apply to individuals, those credits do. And then there's the Series 200, and those credits just apply for the most part to individuals. So all the Series 200 credits are on the form INDCR. Now, House Bill 114, this changes the foster child adoption credit. This credit is currently claimed on the form INDCR. And what it does is it changes the credit for adoptions occurring in taxable years beginning on or after January 1 of 2021. So essentially what's going to happen is there would be essentially 2 adoption credits. If the adoption occurred before January 1 of 2021, you'll use the old credit code. If the adoption occurred on or after 1/1/21, you'll use the new credit code. And just off the top of my head, just from memory, I believe the first one is 208 and the second one I believe is 213. But again, look at the INDCR when it gets published. It will be sometime this month to get the actual credit code, just to make sure I spoke correctly. So now for the new adoptions, those that begin in 21, the credit amount is now $6,000 per year for the first 5 years. Before it was just $2,000 per year. And then it's $2,000 per year for each subsequent year after that. Like before, the credit ends in the year in which the adopted child attains the age of 18. The credit cannot exceed the taxpayer's income tax liability, and any unused tax credit is not allowed to be carried forward. So the credit amount went up, but the carry forward portion was changed. Now, House Bill 149, as I said, this is probably the most significant bill, probably for this community, the bar community. This is the election to pay tax at the pass-through entity level. And what this bill does is allow subchapter S corporations and partnerships to annually make an irrevocable election to pay income tax at the entity level. The bill is applicable to taxable years beginning on or after January 1 of 22. So it's the year that's coming up. And again, that would be the 22 returns that are filed in 23.
John,
Yes.
hey, can I just interrupt you for just a second? When you say the bill would apply to S corporations and partnerships, you mean entities taxed as partnerships, such as LLCs?
Yes.
Okay.
And that's
Just want to clarify.
Yeah, good question, Richard, and a good segue. I'm going to talk just briefly. There's not a slide, but if you're interested, you can go to our website. At the top, there's a tab that says tax policy, and if you click on income tax and then on regulations, you can see the notice. We proposed essentially 7 regulations. 6 of those were related to House Bill 149. One of them was just a cleanup of the accounting period regulation that someone pointed out to us while we were working on this. But you'll see those have been proposed. The comment period is ended, and I think you'll see action from us very soon as far as adoption, et cetera.
John,
Yes.
another question. Do you know where is the statute for House Bill 149 under Title 48? Do you know?
Yeah, I'm pretty sure.
It's 48.7, I'm sure.
Yeah, it's 48-7, and I believe it's 48-7-21 and 48-7-23.
Right. And for those attending, if you actually go to House Bill 149, you'll actually see the bill itself, and it'll say it is amending Title 48 and the sections it's amending. So I hope that answers that question.
Yeah. Oh, so that was a question from someone.
Yes.
Okay, good. I thought you were just very interested in it, Richard.
That too.
But no, if you look at the bill, there were actually other code sections that were also amended in the bill. And and it takes a little digging to figure out why, but the latter code sections that are mentioned principally address like estimated payments. I'm going to talk just a few minutes about that. But it essentially treats these entities like a corporation for purposes of estimated tax credits. So they will use the same form, and that's probably the thing that you want to probably most be thinking about now. It's effective for 22. We haven't worked yet on modifying the forms themselves, but you'll check a box is what we're thinking right now on either the S Corp or the partnership return, make the election. But that will all be done in 23 when the returns are filed. In the meantime, you may have to file estimated tax payments. We heard from a number of people informally about possible problems. And the problems kind of arise because the due date to make the election is when the return is filed, which is going to be in 23, right? But in the meantime, you're going to be required to make estimated payments in 22. So if you look at the reg, there's a whole paragraph on estimated payments. And there's some kind of, I won't call them safe harbor, but penalty relief type provisions that should be helpful to people. One, when computing the underestimated tax penalty, you can assume that say the owners made the payments, but the entity didn't, but then they make the election, you could assume that the entity made those payments, kind of get the relief. So also, because it's an annual election, it's made each year. One, you don't have to tell us if you don't make it the next year, you just don't make it. It is irrevocable, but also like say in 22, you want to make the election. Well, in 21, you couldn't have made the election because the bill is not applicable to 22. There's a provision in the regulation that essentially allows you to kind of look at the income in 21 for purposes of computing the 100% prior year's tax provision. So assuming, return.
John, can you explain what you mean by that for computing the
Sure. So for estimated tax penalties, there are some exceptions. And one is if in the current year you make enough estimated payments to equal 100% of your prior year's tax, then you are allowed, or you won't be subject to a penalty. So for that purpose, you can assume essentially that an election was made, kind of can figure out what the tax would have been. And then assuming you paid 100% of the taxes in 22 versus 21, then you would know a penalty.
So in essence, the dilemma I think that you're describing, John, is that the election isn't made by the entity or at the entity level until 2/23 when the return is filed by the entity. Yet in the prior year, 2/22, if the individual partner isn't making estimated payments because the individual partner is thinking that the entity will be making the election, and then the entity doesn't make the election, then what it could end up, you could have a situation where the individual partner didn't make enough estimated payments. Is that essentially what's happening? Okay.
Well, actually, I was talking about the opposite, where the entity didn't make the estimates.
Oh, okay.
The owner did, and then but I believe, just off the top of my head, I believe we may have addressed the opposite, but
okay.
I can't remember for
sure. That can happen too. It can happen both ways. One or the other doesn't make the election. And when you have large partnerships, it's not like a family partnership with 4 people. You're talking about hundreds of partners. It's not like they're going to have meetings every 2 months to discuss, well, what are we going to do about this election? Exactly. So that certainly could cause some confusion, I guess.
So to the extent we could, we tried to provide some relief. So you can look at the regulation. As far as who, which S Corp, which partnership can make the election.
Yes.
Which you alluded to, Richard. Only entities that are 100% directly owned and controlled by persons that are eligible to be shareholders of an S Corp. So when I first read that, I thought, oh, well, that doesn't seem to make sense in the case of a partnership, but it does. Basically, those that can own an S corp are, for the most part, individuals. I think there's certain trust, I think maybe an ESOP. So those same shareholders, if they're in a partnership, then they could make the election.
And I don't know if you're going to address this, but is there there's some states that say, okay, we're going to allow this election, but it's only allowed for partnerships or pass-through entities where there's active participation by the members.
Yeah, the law doesn't provide anything about active.
So it'll be applicable to a business that's where there's active participation as well as passive participants, such as a real estate partnership. Okay, that's good.
Yeah, it wouldn't
matter.
But again, you've got to meet the rule of being 100% directly owned and controlled. And that's sort of important.
Yeah.
Because like if you've got a tiered partnership that has 10 levels, it would be impossible to track. Because what the bill allows is it allows the owners to subtract the income that was taxed at the entity level. It would be impossible to administer if it wasn't limited.
Agreed. Yeah.
But there's
Thank you.
Sure. There's a whole section in the regulation on, I believe we state that an LLC that's taxed as a partnership could make the election, those types of things. So look at that. And then I think just two more comments on this bill. They pay a flat 5.75% rate, which is our current, I think everyone probably knows this, but you never know, is our current rate on corporations, and then the maximum marginal rate on individuals. So Georgia for years was 6%, and then beginning in 18, it got lowered to 5.75%. There are 3 to 4 pages in the regulation on credits and NOLs, kind of tax attributes and how they're treated, whether they can be passed through or not. And we did kind of the best we could in light of kind of practical considerations. And for example, in the year the credit is earned, the entity can elect to pass through whatever they want to the owners. And the reason why we did that was the election is made only on income that's taxed, basically on Georgia income. So, if the entity has an apportionment ratio of 25%, then only 25% of the tax of the income is going to be taxed at the entity level. And let me just say one more thing, Richard.
Okay.
Tie it together. So if we wouldn't have allowed some credits to flow through, then you would have credits sitting at the entity level where all the income wasn't. So it just made sense and the form is already set up to allow that. So go ahead, Richard.
Just so to wrap a bow around this, for those of you who are watching or participating, attending, this is the workaround from the 2017 legislation at the federal level that limited the SALT deduction, state and local tax deduction to $10,000. If you're paying $20,000 of state tax, you can only deduct $10,000. So this was a workaround. A lot of states, not a lot, some states have enacted similar provisions, and it provides an alternative or sort of an opportunity to take advantage of what otherwise is a lost deduction at the federal level. I guess the only other concern would be, when do you expect the regulation to actually go into effect if all things go as planned? Because the regulation is really the heart of this. It answers a lot of questions.
Yeah, we hope before the end of the year, before the tax year 2022 starts. So and you're going to see fairly soon.
Let's assume, and I know this is a fluid situation with at the federal level, they're trying to increase the cap deduction. That's not going to change this statute. In other words, if they suddenly increase the SALT cap to $80,000, it'll just mean less folks will utilize the election opportunity under House Bill 149. It's not going to void House Bill 149.
No, I wouldn't comment on why the legislature did it. That would be something they would comment on.
Right.
But the law is kind of what it is. If the
Right.
SALT map were somehow to change, and then that therefore then required a law change, of course, the legislature would have to address it.
Right.
Yep.
Thank you.
I think we're going to move on. Richard, anything else?
Nothing, no other questions.
Okay, good. Thanks. And I appreciate you making sure I fulfilled my time requirement.
Oh, sure.
That's my goal. That's
Got
it.
to do that.
Yes. So House Bill 265, this is the Internal Revenue Code update bill. This year was kind of a weird year. This is the second year in a row we've essentially had two sessions. Last year, because of COVID, they stopped and then started. And then this year there was a special session. But what this bill did was adopt the Consolidated Appropriations Act, which passed in December of 2020. And so therefore, I think everyone's heard of PPP loan forgiveness and the deductibility of the related PPP deductions. We've adopted that. So, and I think federally, it was clear all along that the loan, if you use the loan for what you're supposed to, the money itself was not taxable, but the IRS then came out and said that since the income is not taxable, you can't deduct the expenses, but Congress didn't like that. And they made that clear in the Consolidated Appropriations Act that the deductions were allowed.
And John, if I could just add something for those attending, what happens is when at the federal level, Congress passes a bill, it doesn't automatically change things at the state level, because in Georgia, we're not rolling, I guess they call it rolling versus static. We're static in terms of our legislation. So the General Assembly has to come in and proactively adopt that federal level legislation. And so that's why you have these special sessions with all these bills being enacted at the federal level. Sorry, John, just wanted to explain that.
Good point, actually, Richard. As Richard said, we are a static conformity state, and my understanding is a rolling conformity would violate the Georgia Constitution, because it would essentially be a delegation of authority. Now, I couldn't point to you where it says that, but that's just what I've heard over the years. But there are a number of states that are static. Most, I don't know if most, but actually, I do think most are static, but there are a few that are rolling, but we are not. We're static. So each year they have to be considered. So, okay, House Bill 265, the American Rescue Plan Act, which is kind of referred to as, I think, ARPA, at least that's how I call it. That was signed into law on March 11th of 2021. And that included temporary changes to the taxability of unemployment income, et cetera. So ARPA, it was passed after 265 was adopted. So kind of getting to Richard's point, they didn't address it. House Bill 265 only addresses changes that were made through, I think, December 31st or maybe January 1st of 21. So ARPA wasn't part of 265. So those were not adopted for taxable years beginning on or after January 1 of 2020 and before January 1 of 2021. ARPA was not adopted. So, and if you look at the bill, it actually says 265 is for tax years beginning on or after 1/1/20, but because of House Bill 70X, which I'll talk about in just a minute, you kind of have to insert that and before January 1st of 2021, because House Bill 70X did change things. So for 2020, unemployment income is taxable at the state level, and any unemployment income that was excluded on the taxpayer's federal return has to be added back on Georgia Form 500, Schedule 1, Line 5. So the unemployment exclusion federally was only for 2020. It wasn't like for future years, just 1 year they did it. I think it was 10,200 or up to, and there was some kind of phase out, I think. But, so moving on to House Bill 70X, and this is the bill that the Commissioner mentioned. And the Commissioner did, this is her first year, but she did a really good job. She testified a number of times. This bill was important to us. and I'm not going to go into a whole lot of details. I'm going to more talk about things that were not signed, that were not adopted. There was just one thing. But federally, there were changes to the child tax credit. This is the one that you get for you get for working. It increased the credit for 2021. And so normally a credit wouldn't affect Georgia, right? Because federal credit, we have our own credits, but there is a Georgia credit that is 30% of the federal credit. So it was kind of important that that it be addressed, and that's why we were pretty happy when they addressed it in the special session. But I mentioned it before. This says 12/1/21. It hasn't yet been signed into law, but I checked today and it hadn't yet. But I think
It hasn't been signed yet.
not yet, but it was just sent to the governor not very long ago.
Okay.
So he has, I think, I assume the special session is still 40 days. I think we would expect some action fairly soon, but at any rate, the child care tax credit, it was important that we know, whether that's going to be adopted or not, because you can't, normally the update bill would get signed sometime in March. So if it's signed in March of 22 and they decided not to adopt the child tax credit changes for Georgia purposes, then software companies would have to then redo their software. There's just not a good answer.
Yeah, you're talking, when you say software companies redoing their software, you're talking about the tax preparation software.
Tax, H&R Block, all of those.
Yep.
Tax wise, all of those. So that's why we were pretty happy. And as I said, the commission did a really good job of mentioning that to the legislature at all the committee hearings. So I was pretty happy about that. It did adopt all of ARPA except for one item, which I'm going to mention. But note, it's for taxable years beginning on or after January 1 of 21. So House Bill 70EX didn't adopt any of ARPA for 2020. So the unemployment, that's still taxable. Just kind of keep that in mind. So the one thing that the bill didn't adopt was the changes to the code section 461L limitation. And that's something that limits business losses to business income. So before it was set to expire on 1/1/26. So it will still expire for Georgia purposes on 1/1/26. Federally, it would expire 1 year later. That was the only change. And then I mentioned that we adopted all of this, all of that kind of thing. I was talking about specific acts. I wasn't talking about generally. Georgia does have differences. We work pretty hard to keep our website updated. We're pretty close to being ready when the governor signs the bill to kind of fold in the House Bill 70EX stuff. So at any rate, to get there, you just go to the Rules and Policies tab at the top, and then you choose income tax, and then you click on the federal tax changes link. So click there and you'll see it talks about what we follow, what we don't follow, that kind of thing. And I think that's it. Oh, but as I said, we have adopted all of this act, most of ARPA, but there are things we haven't adopted over the years, like bonus depreciation, those types of things. But on this webpage, we talk about all of that. So, if this is important to you, take a look at that. Don't come away from this presentation thinking that we've adopted everything, because we haven't. For the most part, we adopt things, but the bonus depreciation, I think when it was originally enacted, I think it was maybe 2002 for 2001, the state didn't adopt it, and we just never have since then. So, okay, moving on, House Bill 593. This increases the individual standard deductions. This is for the 2022 year. So that again would be returns filed in 23. So not the current tax year. And in the case of a single taxpayer head of household, the amount is now $5,400, and I believe it was $4,600 before. In the case of a married taxpayer filing a separate return, it's now $3,550, and before it was $3,000. And then in the case of a married couple filing a joint return, it's $7,100, and I believe it was $6,000 before. It's always twice as much as the married filing separate. For the most part, this is going to affect the next year. But the one thing that is affected is the employer withholding tax tables. And those have been modified. That has been modified for 2022. So we have what's called the employer's tax guide, I believe, on our website.
Employers what?
I believe it's called the employer's tax guide.
Okay, right.
And it's sort of like, well, federally, they used to call it the circular, but I'm not sure they still call it that. Seems like when I tried to look the other time, I didn't. It was very confusing the way they do withholding now federally, since there aren't exemptions. Ours is we still allow exemptions. So ours is the way it's been for years. For the most part, yes.
We do have a question. Do you still have to itemize on your federal return in order to itemize in Georgia? I think the answer is yes. You got to do whatever you do at federal, you got to do at Georgia.
The question is definitely yes.
Yeah.
And the only choice that you could make is, I believe, and of course, you would have to check federally to make sure what I'm stating is correct. But I can't remember what the standard deduction amount is. I think it was 24,000, but I think it was indexed for inflation, so I haven't kept up. But you can choose to itemize even though you don't have 24,000. You don't have as much as the federal standard.
Good point.
So people, do and can weigh, because you kind of lose federally, but you gain for Georgia. So that is something you can do. And again, as I said, that used to be allowed federally, but we don't give federal tax advice. So if you think that,
Okay.
yeah, no, I joke a little bit, but I'm serious about that. Don't take anything we say about federal law. Take it all with a grain of salt, because
Will do.
we for the most
With
part,
with a grain of what?
well, we know, and I'm not good with those kind of
Here's
expressions.
your joke, John.
Hopefully I used it correctly, but I'm pretty sure it's still true, because I've gotten questions about it over the last year or two. But again, but I wanted to point it out because it's something that you may want to look at. Even just personally, it may help you.
Right.
So that's that. Okay, Senate Bill 66. This makes changes to the QED credit. Richard, how much time do I have left?
We are looking at, it's about 2:07 and we're supposed to end at 2:20. So you got some time, about 10 minutes.
Okay, so this is changes to what we call the QBD credit. It's the Qualified Education Donation Tax Credit. This is, I think most people are familiar with the Qualified Education Expense Tax Credit, or what some people refer to as the SSO credit. This is a similar credit, but it's used to help the public school systems. I think for the most part, it's kind of the genesis, but it works almost identically to the Qualified Education Expense Credit and the Rural Hospital Credit, except for maybe amounts may be different. So this bill is very simple. It just normally you make a donation. You used to make it to the Public Education Innovation Fund Foundation, but now you, beginning in 22, you would make it to the nonprofit corporation that's created by the Georgia Foundation for Public Education. So just simply an administrative change as far as who is receiving the donation and kind of giving out the money. So that's that.
Okay.
Pretty straightforward. Moving on to Senate Bill 6, sections 2-1 and 2-2 create a new life sciences manufacturing job tax credit. And just as kind of an overview, I'm going to go into a little bit of detail, but any of you that are familiar with, I think it's the PPE credit. There's too many PPPs. I'm pretty sure it's PPE, not PPP.
Right.
I was thinking about that the other day when I was kind of getting ready for this, and then I just things got too busy and I didn't get a chance to check, but pretty sure it's the PPE credit, which was created last year. It works almost identically, and I'll mention the differences towards the end. But this is allowed to a medical equipment and supplies manufacturer or a pharmaceutical and medicine manufacturer. The manufacturer's got to claim the job tax credit, which is the same way as the PPE credit. And just like the PPE credit, you basically, for every job that's included in the job tax credit, you can claim an additional $1,250 per job for any job that's engaged in the qualifying activity of manufacturing medical equipment supplies or manufacturing pharmaceuticals and medicine. So the credit, like the PPE credit, it can offset 100% of the taxpayer's tax liability. And this does have what we commonly refer to as a withholding tax benefit. So essentially any credit that you don't use for income tax purposes, you can use to offset withholding tax that you would normally send to the department, but your employees still get credit for the withholding, et cetera. So it's that's something that's available with 6, 7, 8 credits. Now, the thing that's different between this and the PPE credit is the job must have been created on or after July 1 of 2021. So you can't get it for jobs that were already existing and you simply maintained. So, and then I don't mention it here, but the second difference is that the PPE credit ends. I think it's last applies to jobs created in 2024 off the top of my head. Of course, then the PPE credit, you create the job in 24 and then you could claim the remaining installments still. But this doesn't have an end date. So
This doesn't what?
Doesn't have an end date.
Okay. All right.
Any job that's created on or after July 1 of 2021, as long as they're engaged in that qualifying activity, could still get the credit. It is applicable to 2021 tax year, so this tax year now. And I think that's the last slide, yeah, for this, but we have adopted the regulation for this. It's on our website, same spot. At the top, tax policy, click on income tax, and then regulations, and you'll see.
And when you say at the top, you're talking about the top of the splash page, the main page for the Department of Revenue. There's a drop down that says tax policy. It's very easy to find, folks.
Yeah, exactly. And we do really try to put anything related to income tax on that, on the income tax policy page.
Good.
A ruling, link, there's policy bulletins, that kind of stuff. But at any rate, the regulation has been adopted. That was just last, I think the last month. And like the PPE credit, this will be claimed on the job tax credit form, the ITCA. There, an additional page was added at the end, just like the PPE credit. The PPE credit is now the second to the last page. And it kind of walks you through how to do it. The regulation does talk about how you figure out how many jobs are created on or after July 1 of 2021, because the job tax credit is done by doing averages. So you have to kind of do a calculation, but there's an example. It's fairly detailed. And I believe Frank's on the call or on this. He was the one that helped me with that. So thanks, Frank.
Frank O'Connell.
Yeah, exactly.
Okay.
Well, I was trying to figure out a way and I talked to him, and then after I talked to him, I said, oh yeah, that will work really good. So
Yeah, it was very well done. Very well done. I thought so too.
oh, thanks. Frank, did you want to make a comment or?
No, I appreciate the mention. Thanks.
Yeah. Frank is really, he's a great boss. So Senate Bill 6, and I'm just about done. This extends, Section 4-1 extends the railroad tax credit until 2026. So it was set to expire at the end of 2023. And this, we will probably be proposing this regulation soon. Wasn't quite as urgent. Just because it's a simple extension and it wasn't set to expire until 2023. We kind of had our hands full and we focused on some of the bigger ones first. Now, section 6-1, this changes the historic rehab tax credit. This does this part does a number of things, which at first glance seems simple, but they're not as simple as you would think. The bill, let me give you just a brief history. So before 2017, a historic home could get 100,000, and anything else, which is what we call any other certified structure, could get up to 300,000. So
And when you say could get up to 300,000, can you elaborate on what you mean?
Sure, in credits.
In credits, you mean the owner can get 300,000 in credits for,
Yes.
okay, rehabilitating it. Okay.
Yeah. Federally, I believe there's either a deduction or a credit as well, but at any rate, the law was changed, and then so for 17 to 21, historic homes were left the same, 100,000, but any other certified structure could get up to 10 million if you did certain things. And there was a cap of 25 million. So before this part of the bill was adopted, the credit was set to kind of revert back to the old law beginning in 2022. So what this bill does is it extends the any other certified structures over 300,000 until 2022. So same $25 million cap for that year. And then it places a project on, or excuse me, a cap on projects for 2022 where the credit amount is 300,000 or less. So that would include historic homes and any other certified structures that are 300,000 or less. So we did propose this regulation. It's been adopted, but we really do read the comments that we get, surprisingly. Well, surprisingly to some. And one seemed important to us. And so what we usually do is we adopt as is, and that's what we did here. And then we repropose. We want something in place. So that accomplishes that, but at the same time, addresses what we thought should be addressed by the comments.
So you'll take that comment, and in the next iteration of the regulation, you'll propose that comment that was made by the outside party.
Yeah.
Okay, I get that.
Yeah, we'll make changes. So, and kind of the reason why we do it that way is we used to have a thing where it was just difficult to finish, and then there's nothing out there.
Right. It never lands anywhere.
Yeah.
And if somebody wants to get a historic rehabilitation credit, the Department of Revenue doesn't administer that, right? That's administered by another agency.
That's a good question, Richard, but that's only partially true. You have to get certified as having historical significance, all that. That's done by the Department of Community Affairs.
Department of Community Affairs. And so before you can even qualify for the credit, you have to go to the Department of Community Affairs and qualify there. Okay.
Yeah, you have to get what's called a Part A pre-approval, which is the preliminary approval. And then you come to us and we essentially give away the money, administer the credit, that kind of thing.
Okay. And that's what I meant. Sorry.
So I mean, this regulation has become one of the longest regulations. It's over 30 pages now.
Yep.
So if you have any clients that this applies to, I won't say it's a good read, but it would be something you'd want to read. So and see, Richard, I did another joke.
No, we want to read that.
Okay.
I look forward to reading all your regulations.
Yeah, okay, so moving on, because I'm about out of time. The last section of the bill, this modifies the research tax credit, and I'm just going to read it. It now provides that any business or the headquarters of any such business that otherwise meets the definition of a business enterprise is not considered a retail business due to the retail activities of its affiliates. So that, I think, is it. Were there any more questions, Richard?
There are no more questions, John. I think we're done, and we thank you very much for your preparation and for presenting. And now we will turn to Ann Whipple and Charles Elrod, and they will give us their update on sales and use tax issues. And I don't know which one of you is going first, I guess, Charles?
Well, I'm going to take the baton from you here, Richard.
Okay.
I'm going to do a little bit of a, I guess, housekeeping state of affairs of our group, and then turn it over and to go first. So without further ado, good afternoon. My name is Charles Elrod. And I work in our sales tax group, I'm a senior manager. Before Ann Whipple, who's my colleague and also a senior manager, before she gets going, I'm going to do the heavy lifting for our group today. But before she starts, I do want to give you kind of a brief rundown of our group, state of affairs, and its current members. It's changed a lot since we all met in person pre-pandemic. And I want to tell you all that. So in the event you have questions after today, at any point during the year, you know, you can reach out to in the event that you have some questions. So first, earlier this year, Mitch Robbins, who most of you, anybody who deals with sales tax and the Department of Revenue would be familiar with, our prior group manager, he left for the private sector. And then also, I'll go ahead and mention that Andrea Shepard left us about a little over a year ago. And the only reason I bring that up, other than the fact that she loved, is that I still have at least one person a week call and ask me where's Andrea. So maybe now it'll be more like once a month. But we miss Andrea, we miss Mitch. But with that being said, so we've had a little bit of a group reorganization since Mitch left about 6 months ago. Amy Oneacre is still our director and our fearless leader. However, Ann Whipple and I have kind of collectively filled the void left by Mitch. So while Ann still takes the lead on most regulations and policy bulletins, and I oversee most protest conferences and letter ruling requests, the one thing I really want to get across to everybody is it's a small group and it's a group effort. So you don't have to spend any time trying to figure out who you need to reach out to. If you have the name or number for one of us, then feel free to reach out and we'll do our best to try to help you get what you need. So without further ado, I'm going to turn it over to Ann. She's going to go over the legislation from the past session, and then time permitting, and I'm assuming we will have some time at the end, I'll hop back on and give a little bit of a, I guess, a brief synopsis on a few letter rulings that we've had over the past year. So Ann, are you ready?
Yeah, can you see my slides?
I can, so I assume that everybody else can as well.
Okay, good. Thanks, Charles. All right, let's see. So I kind of changed the heading here. You can see, because previously it said sales tax legislation, but it turns out that there's also a state hotel motel fee legislation that was passed in 2021. And just to let you know that our group handles multiple taxes. I mean, we're called the sales tax group, but we also handle the state hotel motel fee, the fireworks excise tax, the transportation services tax, non-prepaid 911 charges, and prepaid wireless 911 charges. So that might be helpful to know if you need to reach somebody regarding any one of those taxes. So I'll start with House Bill 160. It's effective May 10th, 2021, and it basically allows cities that connect to the City of Atlanta's water sewer system to enact a municipal option sales tax. That previously most has been allowed only for the City of Atlanta. To my knowledge, no new cities have voted to impose a most, but if they do, or when they do, it'll be a little bit of a heavy lift for the department, requiring pretty significant ITS and GTC programming, but we'll deal with that when it comes. I hope that if a new city comes on board for the most, that they'll put in a lookup tool, like the City of Atlanta currently has a lookup tool. I don't know if you're familiar with that, but the City of Atlanta has a website where you can enter an address and it will tell you whether that address is within the City of Atlanta lines or City of Atlanta boundary, so that you know whether or not City of Atlanta taxes apply to you. So I'm hoping that if other cities impose the most, that they will do the same to make it easy for everybody. Okay, so House Bill 317. this was a little bit more involved. This is the Marketplace Innkeeper law. That's what we call it. It's effective July 1, 2021. It does a lot of stuff. It revises the definition of innkeeper. It defines a marketplace innkeeper. And basically it requires innkeepers and marketplace innkeepers both to collect and remit local excise taxes on accommodations. But just to let you know, we don't administer local excise taxes on hotels and motels and accommodations. So we only administer obviously sales tax on those and state hotel motel fee, which is $5 a night. And lastly, the bill, it imposes the state hotel motel fee on accommodations that were not previously subject to the fee. And I'll get into that a little bit more in a second. Okay, with regard to the definition of innkeeper, this was a pretty big change. And just a reminder, an innkeeper is the person that has to collect the state hotel motel fee. So it revises the definition. Under the old definition, any person, it was kind of confusing, like a circular definition. Any person subject to taxation under this article for furnishing value to the public, a hotel or motel room. I'm kind of paraphrasing, but that was the old definition of innkeeper. Now, under the new definition, innkeeper is changed quite a lot. I mean, first of all, it's imposed. An innkeeper is anyone that furnishes for value rooms, lodgings, accommodations, and who is required to pay business or occupation taxes to their county or city. Okay. Yes.
And so could I stop you there? Just ask you, let's say you have a cabin in North Georgia. I own a cabin in North Georgia, let's say, and I decide I'm going to rent it out, several weekends during the year. Would that make me, do you know if that would make me an innkeeper for purposes of the hotel motel tax fee?
Okay. Thank you. That was a good question, because we're getting a lot of people asking that question.
Right.
So it depends on if you are required by the city or county where that accommodation is or where that cabin is to either be licensed. You can read there on the definition A, be licensed by, or you're required to pay business or occupation taxes to such county or municipality for, because you're operating this or letting out this cabin. And so you would only be required to pay the state hotel motel fee if you're required to do that, to either be licensed by or pay business or occupation taxes to the city or county for the provision of that cabin. But also, and I'm going to touch on this in just a second, it used to be that the state hotel motel fee was only imposed on hotel rooms, and a hotel was considered a building that contained 5 or more hotel rooms.
Right.
So it's really kind of two changes there. So I hope that answered your question.
Well, I think it gives us reason for pause if the General Assembly was trying to protect perhaps folks like me who don't necessarily have a business license, and perhaps I'm not required to have a business license in Fannin County, but I have a cabin up there and I rent it out, which of course that begs the question, what about the companies in Augusta that manage 40 homes for the masters every year? They probably do have a business license. That begs a second question, how much do they have to collect per night? If somebody rents a house out that has 10 rooms in northern part of Augusta or near Grovetown, it's just $5 a night, because even though the house may be 6,000 square feet, it's still just $5 because it's just one big house, one big room. I mean, is that kind of the way of thinking? Okay.
I mean, it's a flat fee, you know.
Right. I guess it becomes a problem when it's never collected and years go by and it hasn't been collected. And that's when it becomes a problem. Folks just need to understand that this is, it broadens the folks that are required to collect this tax. And
let me interject here, and maybe touching on this later, but I feel like it needs to be mentioned now. As we talk about the $5 fee, and you mentioned Augusta and the cabins, it's probably good to just mention the sales tax component as well, because around the 1st of July, when this first came up, I fielded multiple calls where people caught wind of the more expansive definition of innkeeper as it related to the $5 fee. And they learned for the first time that they owed sales tax and had never been properly paying sales tax in the past.
right.
And so, you know, I don't really want to step on Ian's toes here, but I mean, the sales tax piece is not, it's not part and parcel. It doesn't come in with this.
Charles, that's a great point. For those of you attending, there's always been a sales tax on rental of rooms unless the rental is for more than 90 days. That's the only exception. So it's not like this all of a sudden makes everything that in the past was not taxable. It just applies to the $5 hotel motel fee. What Charles was saying is that, hey, you know, don't forget that in the past, you still were required to collect the 7 or 8% sales tax on the rental of a room, whether it's a house or the rental of a house, whether it's the rental of a house in Augusta or the rental of your cabin. And the fact that you're not required to have a business license has nothing to do with it. I hope I said that right. Okay.
Yeah.
Okay.
And then the second part of Marketplace, of Innkeeper is Marketplace Innkeeper, though you can't really tell it from this slide here, but so either you're under A or B, and under B, essentially that definition here, you know, a dealer as defined in subparagraph M3 of paragraph 8 of Code Section 4882, what they're talking about there is a marketplace facilitator. Let me just move to this next page. So in another definition under 481350.2, it says who is a marketplace innkeeper, and a marketplace innkeeper is this person here. So it's a marketplace innkeeper, oops, I went the wrong way, is required to collect the state hotel motel fee. So if you're a person who is required to get a license or pay business or occupation taxes, you're required to collect the state hotel motel fee. Or if you're a marketplace innkeeper, you're required to collect the state hotel motel fee. And I don't know how familiar people are with marketplace facilitator. Basically, well, all the details, I think, are pretty well laid out in Policy Bulletin FET, which stands for Fees and Excise Taxes 2021-01, which is on our website.
And that's on the website. If you go to the main splash page under tax policy and go to sales and use tax.
Yeah,
that's where you'll see it.
I think the tab is rules and policies.
Rules and policies. Okay.
Then go to the sales tax
section.
Yeah, click on that and then it'll take you. I mean, briefly, it's kind of hard to describe what a marketplace facilitator is without reading it, because it just sounds like a bunch of words. It's like, I tried to write it down and say it out loud. I'm like, I don't have a slide on it. So, so it's kind of much, but I would just encourage people to go to the bulletin and check out. Well, we also have a marketplace facilitator bulletin. If you read that and a marketplace innkeeper, or pardon me, it's called Changes to State Hotel Motel Fee, effective July 1, 2021. If you read either one of those or both together, you'll get a really pretty good idea of what a marketplace innkeeper or a marketplace facilitator is. So unless I need to go into it, I don't think I will. But just to let you know, we also have a state hotel motel fee regulation that is not caught up to these new changes yet. It's on the chopping block. We're hoping to get that out in the coming months. That-
And if I could just interrupt housekeeping matter, if somebody has a question, you go to the bottom of your screen, there's a Q&A section, and that's where you type your question, and we'll try to get it answered. I'm sorry, Ann, go back,
Oh, should I?
continue. No, I'm handling the questions. I just, somebody raised their hand. And I just wanted to let the attendee know that if you have a question, type it in the question and answer section. You don't need to worry about that, Ann. I just wanted to answer somebody's question.
Okay, thanks.
Thank you.
So again, I just want to reiterate that under the new House Bill 317, that the fee applies to any accommodation that provides a physical shelter, as opposed to the old state hotel motel fee that was only applied to hotel rooms, which was a hotel, again, it was a building with 5 or more rooms under common ownership. And who has to collect? Innkeepers, only innkeepers have to collect the state hotel motel fee, but remember that includes Marketplace Innkeeper. And a Marketplace Innkeeper has to collect it even if the owner of the cabin or the hotel or whatever it is not itself an innkeeper. So, that's
Very
a
good
little
point.
nuance there. And just another side piece is that the sales tax base, because remember now on an accommodation, if you're renting out a hotel room, it's going to be subject to state hotel motel fee and sales tax. So when you're calculating this tax base for sales tax, you would not include local excise tax or the state hotel motel fee, but you would include any like facilitator fee or cleaning fees. And this is touched on in our bulletin. So I'll move on. Okay, this is House Bill 374. Basically, this just gives an exemption for an entity-based exemption for water sewer authorities, July 1, 2021. Of course, this does not include anything that constitutes real property, but it's just an entity exemption for water and sewer authorities. And we have already revised Form ST5 to accommodate this exemption. See, moving on here, we have House Bill 498. This is it's a new exemption effective May 7th, 2021 for watercraft, sales of watercraft to non-residents, but it's only for sales of mechanically propelled watercraft, meaning has a motor that propels the boat. And it has to be sold by a licensed dealer to an individual who resides outside the state, and only if the watercraft is immediately removed from the state for exclusive use outside the state, and the purchaser provides to the dealer proof of residency outside the state. The department has already issued policy bulletin SDT 2021, the exemption of non-resident purchases of mechanically propelled watercraft, and Form STW8. And so the dealer has to accept a fully and accurately completed STW8, and the purchaser needs to give over some form of state identification to the dealer. And then every year the dealer has to report to the department. So the reporting is due March 31st of every year, but the first year will be 2022. And we have not finished building out that module on GTC. So once that is done, we will post instructions on how dealers are to report this information to the.
And you mentioned we have not made changes on GTC. You're referring to Georgia Tax Center, where
Sorry.
folks go online. It's the online portal, right? Where people go online to file sales tax returns and withholding returns. Okay. Just wanted to clarify. Thanks.
Thanks, Richard. I thought I mentioned also, so we have another policy bulletin that's still on our website that sort of conflicts with this one that we are in the process of revising, which is sales and use tax bulletin 2011-12-12, which is the application of sales tax to watercraft and trailers. So we'll be revising that one soon, I hope. That's the plan. Okay, House Bill 575. Okay, so what this does is that this is the so-called OLOST. This is currently consolidated governments, which is like Macon Bibb, for example, or Augusta, Richmond. I think we have 8 consolidated governments in Georgia. They can increase their loss from 1% to 2%. And that they could already do that under 48,896. So this new bill adds a new code section, 48,897. I think the lead in subparagraph A is a little bit less restrictive in 48,897 than it is in 96. So it just provides another avenue for consolidated governments to be able to raise their loss if they have a loss from 1% to 2%. And in fact,
when you say lost, you don't mean LOSS, you mean the local option sales tax.
yeah, sorry.
Right.
I get to talking in jargon sometimes and forget. Thank you.
No, it's all good. It's all good.
And so I think people call it the OLOST because I'm not really sure the history.
It says other local option sales tax.
Right. I don't know. It's identified with an O on our rate charts, but O for other. But Macon Bibb, they voted to basically raise their loss to 2% pursuant to this code section.
Which would mean that instead of the highest rate being 8%, it's possible it can be 9% now.
It could possibly.
Yeah, okay. In those areas, at least, in those areas that have the consolidated governments. Okay, sorry.
Okay. House Bill 588. All right, so this one is talk about a lot of jargon. This one is applicable. This is kind of a mouthful, but this is applicable, just so you know right off the bat, so you can tune out if you're not already tuned out, that you tune out because this is only applicable to sellers of fuel used exclusively by common or contract carriers to operate locomotives. So it's pretty narrow. And it's also applicable to common or contract carriers using fuel exclusively to operate locomotives. So it basically effective July 1, 2021, the legislature wanted to appropriate a certain amount of money to the Department of Transportation. This is all in the bill, it's what the bill says. And so that money that the legislature wanted to appropriate is equal to the amount of state sales and use tax paid on fuels used by common or contract carriers exclusively for locomotive operations. So in order for us to know how much sales or use tax is paid on this or remitted on this, we had to change the Georgia Tax Center. We had to change the sales tax return. So now one would report these sales are used as using code CF. And again, this is all spelled out in Policy Bulletin SUT 2021-02. And that lays out in detail exactly what's required for this narrow, set of people that needs to know about House Bill 588.
And
yes,
we have a question from the audience about the OLOST.
Oh, okay.
So the question is, if the OLOST monies have to be used to help reduce the ad valorem tax. Do you know anything about that?
I mean, I believe that my reading of that statute, I believe that is correct. Of course, we don't really deal with that end of it. We just administer the tax and distribute it, and how people use it. I mean, that's kind of
A local.
Right, but that was my reading of that statute.
That whatever monies that the Macon County, for instance, may get from the OLOS proceeds that are distributed to Macon County from the Department of Revenue there has to be an equal, I don't want to say abatement, but reduction of property taxes, ad valorem property taxes.
And that's handled, by the locality itself, by the county.
Okay.
So we just distribute it, and then they follow the rules.
Well, they're supposed to, at least.
Right. Good point. Okay, so Senate Bill 6 had a lot of stuff in it. First of all, it extends the exemption for competitive projects of regional significance. I don't know how much I need to get into that, but it extends it to 2023, June 30. This bill also, it reinstates the fine arts exemption, which is an exemption for sales of tickets to certain fine arts performances. So this one has been kind of revived and will go from July 1, 2021 and end December 31st, 2022, unless of course it's extended. We put a policy bulletin out again. We updated it, let me say, for sales and use tax 2017-07 exemption for admissions to certain performances and exhibitions.
And Anne, I'll just add as sort of a footnote to all of this. For those of you who don't know, sales of admissions, whether you sell an admission or you sell a ticket for admissions, that admission charge is taxable. And so this is sort of a carve out for specific locations. And I don't want to get into the carve out. It applies to specific locations. And this carve out says you don't have to collect the sales tax on sales for performances at this particular venue that qualifies. And again, I don't want to get to which particular venue we're talking about, but that's what this says. So
Thanks.
It's narrow.
Yeah, very, very much so. Thanks, Richard,
Sure.
for that. Okay, so still on Senate Bill 6, it reinstated a manufacturing exemption for certain machinery equipment used to mix, agitate, and freshly mixed concrete. So it goes from July 1, 2021, ending June 30, 2026. And we've already revised our manufacturing exemption to get the dates changed. Senate Bill 6 also extends the exemption for certain boat repairs until June 30th, 2031.
Anne, can I just clarify something or ask you to clarify something? So that first bullet point there, I'm sorry, go back one. Yeah, that one, section 5.3, you say reinstates the manufacturing exemption for certain machinery and equipment used to mix, agitate. That's talking about the cement trucks that are driving all around, right?
Yes.
The cement trucks. Okay.
Yeah.
Thank you.
Okay. All right. So the last thing that Senate Bill 6 does is it makes several amendments to the high technology computer equipment exemption, which is under 48.8368, which there's also one under 68.1, which is for data centers. And sometimes people get those exemptions confused. So we're talking here about high technology companies who purchase computer equipment under 48.8368, this exemption. And so what this bill does, the language of the bill, it updates the NAICS codes and it clarifies the term computer equipment. It clarifies that, according to the bill, it does not include any wireline or wireless telecommunication systems. It also sunsets this exemption June 30th, 2023. So we'll have to see what the legislature does if it, extends this exemption out. But I think one thing we've been getting a lot of calls on is regarding the annual reporting. which is, I think the bill was very confusing on this issue. We do have policy bulletin 2021-03. But, basically the bottom line is that the report, taxpayers are required to report the amount of sales and uses that were exempted in the previous calendar year, and to report to us the facilities where exempt computer equipment is installed, and so, or incorporated, or whatever the verb is. And so the first reporting is due in 2022 for calendar year 2021. And then the penalty under the law is that if you do not report by this date, March 31st, then the department is not going to give you under the terms of the bill, is not going to give you an exemption certificate for the year following the year that the reporting is due. And that wraps it up. Charles, did you have some other things to say?
Richard, you tell me. I'm happy to roll through.
Yeah, we've got about 5 minutes if you want to just
Okay.
add a few things.
Sure.
And thank you all for putting your email addresses on there. That's helpful. Charles?
Just trying to turn my video. There we go. So in the past year, and I think it's probably pandemic related, where people are really focusing in on what absolutely has to get done versus exploring letter ruling routes in a lot of situations. For late 2020 into early 21, there was real dearth in requests. I believe the total was 5. And during that time period from about, say, November of last year till about 3 months ago. And of those 5, well, 4 of them, once they received their preliminary answer, a couple of them received preliminary drafts, pulled back their requests for various reasons, not all because they were necessarily adverse. So what I'm going to do today is I'm going to quickly give you the brief, quick one that actually is official. And then there's 2, or at least one I'll probably end with, that is just a good topic that may make people think a little bit about our manufacturing exemption. So we had a request as related to from a company that made medical devices, including the sale of heart rate monitors. The monitors, they are single use, they are placed under the skin, and they are by prescription only. And I say that for all of those who are familiar in sales tax. I mean, this is a lot of the magic language that you find in the defined terms of prosthetic devices and durable medical equipment. Here specifically, they were asking about prosthetic devices, and the purpose of this device is solely to collect data for heart rate irregularities. And so the issue was whether it qualified as prosthetic device. Our answer was pretty short and sweet. We said it's not a replacement, corrective, or supportive device. Furthermore, it does not replace a missing portion of the body, prevent or correct physical deformity or malfunction, or support a weak or deformed portion of the body. Those are the requirements that would make it be a tax-exempt prosthetic device.
Such as an example would be
A fake leg.
an artificial leg, right?
Artificial leg, sorry.
Okay.
Artificial, correct term. Thanks, Richard. Yeah, an artificial leg would be the easiest term. So instead, this device is solely used for diagnostic purposes in connection with the detection for potential arrhythmia of the heart. And so that one was pretty short and sweet. And so that was that one. And honestly, this particular company, they asked, they knew the answer. They had a competitor out there that was selling exempt, and they used the letter ruling avenue as a way to get out in the public domain, something for their competitor to see who was doing it the wrong way. So that was a first for me as well, Richard. I saw you kind of shake your head there. Another one, it's really 2. And within 3 months of each other, we received 2 requests that are virtually the same. They both come from entities involved in the chicken manufacturing or processing business. And the primary question, well, both plants were involved in receiving raw chicken at room temperature and butchered chicken already broken down and chopped up into parts. And then they both cooled down the chicken, stored the chicken in a cooled state, and then also packaged the chicken for exit delivery out of the plant. The primary question, and then I should add, both of them, the particular process that some, but not necessarily all of the chickens undertook was the flash freeze, a rapid blast, or chicken blast, whatever the term is you want to use, whereby the chickens were not simply stuck into a refrigerator. They actually were put into a chamber that within a couple of hours, the temperature of these temperatures dropped by, say, 50 to 60 degrees. It's kind of become the standard for keeping the molecular integrity of chicken when it is frozen down. And so the question came to us of whether or not the chicken blasting constituted a qualifying manufacturing event. Under the reg, as well as the statute, most of you who work in this area would recognize that the question boils down to whether or not there was a transformation event, a change or transformation event to these chickens. We have said yes. We actually had said yes a long time ago before letter rulings were made public. So it's still not in the public domain because both of these, well, one pulled back, one went ahead and filed for a refund. So we can't give them any sort of definitive answer. But I tell everybody this because then there's a part two. I don't know how many people care about the chicken blasting, but once they had the chicken blasting that qualified, then we were able to say that all, as such, all machinery and equipment involved in the blasting was exempt, subject to certain conditions being met, including that the substantial purpose of this machinery and equipment was for the blasting of the chicken. But then also, there really became this that both parties want to know about was that whether or not we found there to be an integrated manufacturing operation going on at these two plants, multiple plants for both of the entities, but an integrated manufacturing operation taking place whereby other equipment or machinery at the facilities could qualify. And we said yes to that because based on statute and regulation, anything that is involved in the processing, in the manufacturing event as a whole qualifies, the machinery and equipment will qualify up until such time as the packaging is complete. It's a long, our draft response was extremely long. So giving a synopsis is a little bit difficult, but I just wanted to point out that we did tell this group that chicken blasting qualified, and both these groups of chicken blasting did indeed qualify. It opened up the opportunities for more machinery and equipment to qualify within these various plants. So, Richard, do you have any questions there?
No, just a reminder to everybody that about 10 years ago, we had a change, a pretty big change in the way machinery and equipment used in manufacturing was determined to be exempt. And it's now a broader exemption that applies. You heard Charles mention the integrated plant theory. So more equipment, more machinery is going to qualify than in the past, when I'm talking about the long past. It doesn't have to necessarily directly touch the item like it used to in the past. Unless the machinery touched the item that was being manufactured, it didn't qualify for the exemption. At any rate, I think we're out of time, Charles.
Well, it'll take 10 seconds, Richard, to say, I mean, it's not Katie bar the door, right? I mean, the blast freeze was, I don't want anybody on this phone call to think that any sort of the storage, which we would give them.
Well, that's true, right.
The cold storage would be part of the process up until the time that it was out the door, but that's only because it came after the qualifying manufacturing event took place. So just storage alone, including refrigeration storage, is still emphatically not going to be subject to exemption for manufacturing machinery and equipment if it's standalone activity.
Great. Charles, thank you very much. Both of you, Ann and Charles, for really doing a great job on your first time around this year. And with that, we'll move to Ron Stay, another new face, who has now replaced Alex Sponseller. And so we welcome Ron, and he's going to give us the litigation court decisions update. Ron, I'll turn it over to you.
Okay. Thanks, Richard. As Richard mentioned, I'm the new Alex. I am the section chief of the tax section at the Attorney General's office. Our role is to represent the Department of Revenue in court, both in the tax tribunal as well as in, Superior Court, State Court, Court of Appeals, the Supreme Court, et cetera. So there are 5 of us. Actually, right now there's 4 of us. We have 1 open position because Alex left in our group. And that is what we do. We primarily or almost entirely represent the Department of Revenue. So what I'm going to talk about is cases, both tribunal cases and cases in the superior and appellate courts that the Attorney General's office has, tax cases where we've represented the Department of Revenue in this past year. Because this is kind of a rolling list, some of these cases have been talked about in past years, and what we will just do is update them for whatever developments occurred in 2021. So those of you who've been to this update in the past or this liaison meeting in the past may recognize a lot of these cases. Some of them are new, some of them are not. And we have organized them in the materials by rough subject area. And so I will go through them in basically the order that they are listed there. The first grouping that we have are some sales and use tax cases that we've handled for the department. First one on that list is the new singular wireless cases. These have been around for a while, but they finally came to a conclusion this year. So this will be the last year they'll appear on this list. And basically what happened there is those cases, which went all the way up to the Supreme Court, presented the question of what happens with the sales and use tax refund when it's initiated by a court order. And in that case, it was a class action. The order resolving the class action basically calls for a refund of internet access fees that included sales taxes to customers. AT&T, who's a successor to New Singular or Singular Wireless, y'all remember Singular, sought refunds from the department. Those refunds were denied. The case wound up in Superior Court, and AT&T's complaint in Superior Court was dismissed, and the Superior Court basically did that for the department on 3 bases. The first was that they had not already reimbursed the customers for the sales tax per the regulation that says that when a sales tax is basically ruled, illegal, that the customers have to be reimbursed first before the department will reimburse the sales tax to the vendor. Secondly, that the second 2 were more technical. There was a standing issue, which basically meant that AT&T, which was a successor, didn't have the standing to ask for the refunds prior to some changes in the sales tax refund statute in 2009. And third, that refunds based on class action orders are not contemplated under the statute. So long story short was that we won. The department, when I say we, the department won at the Superior Court level, and the Court of Appeals basically sided with the department, and the Supreme Court sided with AT&T. So it went back and forth between the Court of Appeals and the Supreme Court, with Court of Appeals saying yes and the Supreme Court saying no a couple of times. And finally, this case was resolved in this past year, and it is now over. So the end result from the Supreme Court's standpoint was yes, a sales tax refund. Basically the last word was theirs, was that it could be issued based on these circumstances. Another sales and use tax case was the T-Mobile, or is the T-Mobile case. And by the way, in your materials, we have all the case sites for these if you want to go and look at the public documents and the public orders resolving these. T-Mobile, a case which is currently pending in front of the Court of Appeals, presents a case concerning the high-tech exemption, which is found at 488368. And that exemption from sales and use tax concerns the purchase of $15 million or more in computer equipment. And in this case, the question is whether T-Mobile, when they upgraded their wireless network in Georgia to the LTE, they bought a whole bunch of equipment for the LTE technology. That's the kind of the fourth generation of cell phone technology that most of us use in our cell phones now. And when T-Mobile spent a whole bunch of money to make that upgrade, was it subject to the high-tech exemption? And it really presents the basic question of, is that equipment computer, I'm using the air quotes, computer equipment as that's contemplated in the statute, or is it telephone, central office equipment, or other voice data transport technology, which is not subject to the high-tech exemption? And that's really, to put it crudely, what's being litigated now in the Court of Appeals. And it presents that basic question of nowadays cell phones, they're not really just phones anymore. They're used for calls. They're used for a whole lot of data, surfing the internet and that kind of a thing. So, this is the high-tech statute, did it contemplate this particular situation? So T-Mobile prevailed in front of the tax tribunal. That decision was appealed to the Superior Court, and the Superior Court sided with the department. And the Superior Court's decision has now been appealed to the Court of Appeals, where the briefing has occurred. And we basically at this point are awaiting a decision from the Court of Appeals to see what they decide on that issue. Another couple of sales and use tax cases that I'm going to group together because they concern kind of the same broad subject area of transportation is executive limousine and the Uber case. And in the executive limousine case, the question was where a limousine company, which was basically dispatching limousines or hiring out limousines that were operated by, in a lot of cases, independent contractors. Are they subject to collecting sales tax on behalf of those drivers? That was, kind of presented two interrelated questions, which is that, is the limousine company, providing transportation? Are they a dealer in transportation services such that they're subject to sales tax? And also, does the Department of Revenue's headquarters operations rule, which is a regulation promulgated by the department that basically says that if you are a headquarters operation, in other words, a entity that's controlling taxi cabs or cars for hire in a headquarters capacity, taking in the calls, dispatching the cars, that kind of thing, does that apply in this circumstance? And in this particular case, the tax tribunal ruled in favor of the department and held that, even if the limousines were being independently contracted, even if the executive limousine transportation did not own the limos and did not directly employ the drivers, that they nonetheless were subject to collection of sales tax under the department's headquarters operations rule, or regulation rather. That finding was upheld by the Superior Court, and that finding very recently, about 3 weeks ago, was upheld and affirmed by the Court of Appeals. There was a previous case that also dealt with that headquarters operation rule, the taxi cab headquarters operation rule. It's also known as called Adam Cab. That was a Supreme Court case. And this case dealt with similar, similar subject area. There is now a petition for cert pending in the executive limousine case. That briefing was just completed. And so we will see whether or not the Supreme Court wants to take that up. Somewhat related, at least to the same subject area, that brings us to Uber. The Uber case is pending in front of the tax tribunal right now. And it presents the issue of, okay, if executive limousine talked about, a limousine company with independent contractor drivers, what about Uber? And Uber's a related but distinct issue of technology companies such as Uber. Are they dealers in transportation services, as the department contends, or are they merely, are they what they call marketplace facilitators, tech companies that are not directly dealing in or selling the transportation, but facilitating a transaction, bringing a independent buyer and independent seller together by use of technology to, provide transportation in that respect. And it's a situation or an issue I think you see a lot with Silicon Valley companies these days. You look at other I know that in the employment context, there was a big there have been disputes in other states about does Uber employ its drivers? Are they independent contractors? Should they provide benefits and that kind of a thing? So as technology changes and the marketplace changes, these companies with these business models, is it a new business model or is it a business model that's already accounted for by the existing law? So that one's pending before the tax tribunal right now. It also involves, in addition to interpreting the sales and use tax statute, it also involves that headquarters operation regulation that we just discussed in executive limousine. Right now, some dispositive motions have been filed and they will be heard. That's really all we can say about that particular case. Those motions have been sealed. So, there's nothing further we can really say other than that case will continue on, certainly, obviously, past the end of this year. Next, case is on the listing for sales and use tax, Quest Diagnostics Clinical Labs. That was another one that has been around for about a year or so. And in that one, it was a diagnostic lab, and their issue was purchasing chemical reagents to perform diagnostic tests, and whether or not purchasing those reagents qualified for an exemption from sales tax is called the prescription drug exemption. It's in 48.8347(a)(i). And what that exemption says is the sale or use of drugs which are lawfully dispensable only by prescription for the treatment of natural persons. And so Quest Diagnostics' position was that the tests that they're purchasing the reagents for, this is something that would be done in a lab. They diagnose disease and they can only be performed if a doctor orders them. So, the department's position was, well, the reagents themselves are not administered to patients. Basically, the argument, the contemplation of this thing is, these are going to be drugs that a doctor prescribes that an end user, a patient, actually takes and ingests into their body. And that's the plain language of the exemption. And furthermore, the department said, the reagents themselves aren't prescribed. The test may be prescribed, the test may be ordered, but the reagents are not. So in the tribunal, ultimately, the department was able to win on summary judgment after a reconsideration for a couple of reasons. First, the reagents themselves were not dispensed solely by prescription. And secondly, perhaps more importantly, the reagents that were being purchased were not being purchased for, quote, the treatment of natural persons, which is in the language of the exemption. Did somebody say something?
Yeah, as I understand it, reagents are just substances that are used to mix with, to perform a test. Is
Right.
that your understanding of it's kind of maybe a misnomer. I don't know, but that's what
Right,
what
right.
they're-
We're
that's
talking
what they're
about
used for. Okay.
diagnostic testing. So
Right.
exactly. So,
They're used to
diagnostic-
get a result and to analyze data or analyze
Yeah.
the blood, the specimen. Okay.
Right. It's like
Sorry.
a base chemical,
Right.
It's not an actual, it's
Right.
nothing that you'd ingest into your body.
Right.
It's something that a, pharmacist or a doctor would use or a lab
Okay.
would use.
Great.
So, but yeah, and that was kind of the, the tribunal. And then again, with the Superior Court who affirmed the tribunal was pointing out was that, these reagents themselves were not for the treatment of a natural person. In other words, it's not, like taking, your allergy medication or something like that. What happened in this past year is the Court of Appeals granted an application for discretionary review. That was at the very end of 2020. This past year, the case resolved. Quest did not file a brief in the Court of Appeals and withdrew the appeal. So that case is now over as of 2021. And there is no appellate law. There's just the Superior Court's decision, but that did affirm the department's position. So that's Quest.